Hi guys, this is Andrew from Dividend Growth Masters, and today I want to talk about a very interesting topic when it comes to investing, and that's analyzing stock-based compensation. Now, for a lot of companies, especially tech companies, stock-based compensation is a big part of their expenses, and it's because it's one of the primary ways they compensate employees. They give them stock options, restricted stock, etc. So they try to align the interests of their employees with the company. So if the stock price goes up, the employees make more money. It's a pretty simple concept. Now the issue is a lot of companies they try to pass off stock-based compensation as not a real expense, even though it is a really big expense. And this is really prevalent in big tech companies. And we're going to cover two today. So starting with Salesforce. So this is Salesforce's latest results, third quarter of 2023, for the quarter ended October 31st, 2022. So as you can see, based on the headlines, they give a quick high level of the results, revenue, earnings, etc. Their guidance. So what's interesting is if you look at the second line item here, it says GAAP earnings EPS of 21 cents and non-GAAP earnings of $1.40. Now that's a big difference. That's basically the non-GAAP earnings is basically seven times higher than their GAAP earnings. Now non-GAAP is basically a metric that's not accepted by generally accepted accounting principles, or also known as GAAP. Now the reason why companies do this is they want to basically exclude certain items that they don't think are show the true earnings power of the business, and that's why they have this non-GAAP earnings metric in the earnings release. Now, if companies do report a non-GAAP earnings metric, they are required to basically reconcile between the reported GAAP earnings with the non-GAAP metric. So let's take a look at that. So if we scroll down, we can see the reconciliation between GAAP earnings and non-GAAP earnings. So let's look at the 3 months for October 2022. So they reported GAAP earnings of $460 million. They added back amortization of purchased intangibles for $474 million, and also stock-based compensation expense of $843 million. So then that's when you add that up, they reported GAAP earnings of $460 million, but they have non-GAAP earnings of $1.78 billion. Now that's a huge difference. So if you do it on a per share basis, basically they're reporting earnings of 21 cents per share. But on a non-GAAP basis, they have $1.40. And the biggest reason for this is they're excluding stock-based compensation expense. So remember, stock-based compensation is basically bonuses and part of employee and management compensation that they're giving to employees, low-level workers, C-level executives, and anybody in between. And the reason why this is important is because it's a really, really big expense. So, for example, for October, for the quarter, they had 843 million of stock-based compensation expense. And in that quarter, they only generated revenue of what is the income statement? 7.8 billion. So stock-based compensation is basically almost 11% of their entire revenue. The reason why stock-based compensation is a very important topic is, well, in my opinion, two reasons. Number one, it's a really big expense. It's 10% of their revenue, 11% of their revenue, basically. And if the management team didn't provide stock-based compensation to employees, they would have had to pay them some other way, because stock-based compensation is a big component of an employee's total compensation plan, especially for tech companies. So if they didn't give them stock, they would have to give them cash or compensate them in some other way. So a lot of people, especially me, argue that it's really not a non-cash. I mean, even though it is technically a non-cash expense, it's a really big real expense that the company incurs. And the reason for that is because they give stock away, which means they're diluting shareholders. So basically, you're giving stock to your employees, so that means the share count increases significantly. So if you look at the share count from the 10K for Salesforce, you can see that the share count has been increasing rapidly over the last 3 years. So in 2022, so in 2020, they had 850 million shares outstanding. And 2 years later, in 2022, there's 974 million. So basically, their share count increased by almost 15%. And that's dilution to you as the shareholder of the company. And the reason this is important is because when, or if and when, the stock price declines of a company like this, it has a very bad effect on not only the stock price, but also the operating environment of the company. So let me explain. So if you look at Salesforce right now, year to date, they're down about 49%. If you go out a year, so the issue why this is super concerning is because when the stock price declines, the employees, the compensation that they thought they were getting is nowhere near what they thought it was going to be, like say a year ago. Yeah, welcome to the chart. Okay, so basically, like say a year ago, the shares that they received for the stock options were going to be worth around 255 per share. But today, it's 130, basically half of what it was a year ago. So imagine your compensation is getting cut in half. And the reason that's really concerning is basically there's a lot less incentive to stay with the company. So if and when they leave, that's basically going to be a very big impact on the company because you have a bunch of employees leaving because their stock is basically worthless now. Now, a very extreme example of this is also another popular fintech company, and that is Robinhood. So if you look at their latest financial report for the Q3 2022 results, you can see the same thing. So they reported a net loss of 175 million, but they reported adjusted EBITDA, a non-GAAP metric, of 47 million. So the large difference between that is also, again, the stock-based compensation. So if we scroll down to the disclosures, okay, for the 3 months, September 2020, 2022, they reported a loss of 175 million. But look at all the adjustments they're making. So the largest one is right here, stock-based compensation of 110 million. And that's how they're getting their quote unquote net profit, their adjusted EBITDA of 47 million. And this is really concerning because you're getting diluted significantly. So if you go to the 10K, Robinhood's 10K, you can see their share count absolutely exploding. So if you go to the income statement, you can see from 2019 to 2021, their share count increased from 221 million to 225 million to 492 million. So basically, it doubled within a lifespan of like 2 years. So basically, if you own like 50% of the company and the share count doubled, you own half of the company now. You own 50% less of the company now. So shareholders are getting diluted significantly. And if you look at Robinhood, stock price, it's down 55% year to date for 2022. And again, when employees are having their compensation, a large portion of their compensation drop significantly like this, there's really no incentive for them to stick around. So they start bailing, they start leaving, they start quitting their jobs, etc. And it just has a really bad cascading effect on companies. So, anyways, this is a high level overview of stock based compensation. So, even though a lot of companies pass it off as a non cash expense, it's a really real expense and it really has a big impact on you as an investor or shareholder of the company.